Good evening, everybody. I am very excited to be here today. My name is Elias Kiepentrog. I am an economics student here in the beautiful Netherlands, and I am also the founder of the Kiepentrog Stock Market News. The Kiepentrog Stock Market News, it is a weekly podcast in which I summarize and explain every single trading day so that you can spot the bull in every scenario. And I also analyze economic data and earnings reports. So anything about economics, anything about the world of finance, about the corporate world. If you want to know how events in the economy affect the stock market, then my podcast will definitely keep you informed. Now, I decided to create a little addition to my podcast. What I will start to do is I will answer a question of the day. Meaning that I will upload a video every single day in which I answer a random question of the day that is highly relevant at the moment. And I will, maybe in between 5 and 10 minutes, explain that question to you and also explain to you how the answer to this question can be applied to the current situation in the economy or the stock market, and how it relates, obviously, to the stock market. So everything always comes down to the stock market here, the Kiepentrog Stock Market News. So I hope you will enjoy my new idea, this new concept of the Kiepentrog Stock Market News. And yeah, let's get to it. All right, now today's question of the day is, do the recent events in the banking sector create a policy implication for the Federal Reserve? Now, let's start easy. Let me break this question down. Let me explain it to you very quickly. Now, recent events in the banking sector, what do I mean by that? Well, I think most of you already heard, especially if you are interested in this podcast, you probably have already heard about the recent collapse of the Silicon Valley Bank and other events in the banking sector in the US. There's simply regional banks getting under a lot of pressure, right? Signature Bank is another example. And by policy implication, I mean, so the Fed is currently doing the fastest interest rate hike cycle that has ever been seen, right? So they're raising interest rates very, very quickly. Now, policy implication basically means, for example, let's assume that we start to see significant economic weakness in the economy, right? We start to see data come in that shows a quickly rising unemployment rate. People are losing their jobs, investment is coming significantly down, and there might even be a credit crunch, right? Let's say we get that. This would mean that the Fed has to cut interest rates because they don't want to do further economic damage. So bad economic news in the midst of an interest rate hike cycle might be a policy implication for the Federal Reserve. Now let us start at the beginning. A couple of weeks ago, we heard about the collapse of the Silicon Valley Bank. I'm just, in a nutshell, going to very quickly explain to you what happened. Now, what basically happened is, when the Fed starts to raise interest rates, then the yields on treasuries start to significantly rise, right? And rising yields on bonds means that the price of bond falls. Now, Silicon Valley Bank and other major banks, obviously as well, they're holding a lot of treasuries because they're considered to be very safe. Now, what happens when interest rates rise is people start to pull their money out of deposits because leaving them in a savings account or leaving them at the bank is generating a lower return than investing them into, for example, the 2-year or the 10-year treasury, right? Because the 2-year treasury yield has risen so significantly because of the rising interest rates. So people are pulling their deposits out. This is basically how it started with Silicon Valley Bank. Now, in order to ensure that these deposits can be guaranteed, Silicon Valley had to sell bonds. They had to sell these treasuries. But because the yields have risen so significantly due to the rising interest rates, they had to sell them at a loss. Now, when investors heard about this, when customers heard about this, they obviously became very worried. So they started to pull out their deposits. Now, especially in the age of social media, a bank panic like that can spread very, very quickly, and that is why I also believe that the current plan of the Fed, which has been created to prevent such a bank panic, might not be appropriate for the current time, but that is a different story. Now, so that is basically what happened to the Silicon Valley Bank. Now, do these recent events create a policy implication for the Fed? Now, when the Silicon Valley Bank collapsed, when we simply heard about these events in the banking sector, the yields on Treasury started to fall. And this is just simple macroeconomic, a macroeconomic model, right? If the economy shrinks, then income Y falls, which means that the demand for money falls, which means that people will invest in bonds, which means that the yield on bonds decreases and the price for bonds rises. And there's always this inverse relationship there. Now, when we heard about this news in the banking sector, obviously people became worried. They thought we're going to have a banking crisis. They thought this is going to significantly hurt the economy because we might see a credit crunch as people started to invest in bonds. Now what happened then is it is incredibly interesting. And I loved hearing about this in general when I don't know, reading Financial Times, Bloomberg at night. I loved reading about this because after these events in the banking sector, we simply did not get any new bad news, right? And obviously equities reacted positively to that, right? The yield started to slightly rise again because people were thinking, hey, this might not be as bad as we thought it would be at the beginning, right? So what happened then was, obviously we didn't get any new bad news, and what we're getting right now is earnings. We're getting earnings from big US banks. Now think about Citigroup, think about Wells Fargo, think about JP Morgan. All of these big banks have reported earnings that have ended up higher than anticipated. So the big banks are reporting good numbers. Now this means that we might not be in a banking crisis. Mohamed El-Erian has summarized this very nicely recently on Bloomberg Surveillance. He said that, he asked the question, when will we finally stop calling this a banking crisis? This is not a banking crisis, this is a banking tremor. Similar comments are coming from BlackRock. They're coming from Blackstone. They're coming from JP Morgan. All of these major banks and asset managements. The comment from these companies basically is they're saying that the events in the banking sector are not enough for the Fed to start cutting rates. And that basically is the answer to this question. Very short, very simple answer. Do the recent events in the banking sector create a policy implication for the Fed? They do not, because what we're seeing in the numbers right now from the big banks, we're not in a banking crisis. And inflation still remains very high. So in order to maybe bring some clarity to this, and I also talked about this, it says Fed trilemma right here, because we are facing a Fed trilemma. And this is the one thing that this banking crisis has caused. It has made this Fed trilemma worse. Think about it like this. The Fed basically has three goals. One goal is full employment, right, over here on the left. Another goal is price stability. And the third goal is financial stability, right? So right now, price stability is a big issue because we're not seeing price stability. Now, I always have some people arguing with me. They're saying, Elias, we are seeing a decrease in inflation. And what I tell them is, no, we're not. Okay, let me phrase it differently, actually. We are seeing a decrease in the headline inflation, right? In the inflation number that includes food and energy prices. But we are not seeing a significant decline in core inflation, which excludes the very volatile food and energy prices. Christopher Wallace, from the governor of the Federal Reserve, he said that we're not making significant progress with core inflation. So this inflation issue still is very, very, very significant and a very big problem at the moment for the Fed. Now the other two building blocks, the other two goals of the Fed is obviously full employment and financial stability. Let's look at the current state of the labor market, right? We did get some weak numbers a couple of weeks ago. ADP payroll number came in lower than expected, and we saw a rise in initial jobless claims. But then we got the jobs report for, I believe it was for March. Yeah, exactly. It was the jobs report for March, and it showed that the unemployment rate fell to 3.5%. It is an incredibly low level. And the ADP payroll, not the ADP number, but the payrolls number still remains very resilient. So this third goal of full employment, the labor market is incredibly tight. So the labor market cannot be considered to be a problem at the moment. Now, financial stability, right? Very, very important, obviously. But what numbers of the big banks are showing is that we're not really seeing a threat to financial stability at the moment. We are at the beige book of the Fed that was published yesterday has summarized this very nicely. In this beige book of the Fed, it said that we're barely seeing, or we are seeing credit availability narrowing, but we're far away. And Mohamed El-Erian said this too today on Bloomberg The Open, which is a great show, by the way, for people interested in these topics. Mohamed El-Erian said we're not seeing a credit crunch. So financial stability does not seem to be a problem right now. So the biggest problem is obviously inflation. Now, in order to get inflation back to the 2% target, in order for us, for the US economy, to make progress on core inflation, and my very own analyses show that, you can check them out on Greek-Strong Economics. In order to get inflation back to the 2% target, you need the availability of credit maybe to fall. So you need to sacrifice some financial stability, and you need the labor market to significantly cool down. Larry Summers has summarized this very nicely on Bloomberg Wall Street Week a couple of months ago now, actually. He said that in order to get inflation down, you need to get wage inflation down. And in order to get wage inflation down, you need to see slack in the labor market. So the unemployment rate needs to rise. We need to see some deterioration of financial stability, because that is required in order to get inflation back to the 2% target. That is the price we must pay. The Fed, essentially us, that is the price we must pay for the Fed ignoring or for the Fed believing that inflation is only transitory. Just think back to 2022, think back to 2021. The Fed believed, and many believed, right? So you cannot really blame anybody because it was a very uncertain environment. The Fed believed that inflation is only going to be transitory, so they didn't react quickly enough. But the price we must pay for letting inflation get out of hand in history just shows this over and over again. Just think about the 1970s. In order to get inflation down from such a high and sticky level, you need to see the unemployment rate rising, you need to see some deterioration of financial stability. So simply taking into account the recent events in the banking sector, which do not seem to mean that we are in a banking crisis, I do not believe that they impose a policy implication for the Fed. Now, let's go maybe 8 months, 9 months ahead, right? 2024. We might see monetary policy cause a significant decrease in availability of credit. We might see a deterioration of financial stability. And once we truly see that, that could indeed be a policy implication for the Fed. Because if we see that in combination with a unemployment rate that is now much higher than now, then the chance that inflation will fall to 2% is very high. So at that point, these two events in combination with falling inflation might cause a policy implication for the Fed, meaning that the Fed will start to cut rates. But as of now, I'm very convinced you cannot say that the recent events create a policy implication. I must note one thing here at this point. Today's Thursday, I think it's 20th of April. We have seen numbers from the big banks, but we have not seen many numbers from the regional banks yet. So you kind of have to wait on them. And of course, I will report about these numbers on my podcast and also maybe in another question of the day. But I believe that this has been longer than 10 minutes now. My episodes and my videos are always longer than I planned them to be. But I hope you enjoy this new concept, right? These videos are going to be uploaded on YouTube every single weekday in addition to my podcast. And if you have any questions, any inquiries, if you want to propose a question of the day, just go right ahead, shoot me an email. Actually, probably just write it in the comments. It's probably better because I don't want to publish any information. I don't have a business mail yet for my podcast, but I hope you're enjoying this new podcast. Have a great evening and see you tomorrow in another question of the day.